Okay, well, welcome everyone to today's webinar on the Liquidity Risk Survey results. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss highlights from this survey. Our speakers for today are Jeff Weaver, Senior Portfolio Manager at Allspring, and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Jeff and Craig, and I'll now turn the presentation over to you.
Thank you, Brian. Thanks so much, all of you, for spending some time with us this afternoon or late morning, depending on where you're located. And Jeff, it is good to present on this information with you.
Well, thanks for having me, Craig. I really appreciate all the attendees on the line today, and appreciate coordinating with you.
I've enjoyed our conversations, and we had a recent podcast where we threw a bunch of ideas around and talked about them. It was fun. So for those that pay attention at the end, there'll be a link for where you can listen to that podcast. But let's get to our agenda. All right. So what are we going to be covering today? We have the table of contents up there for you. We'll cover some information about the survey. We had over 160 respondents. This was the 11th year we've done the survey. I think this is we started this back, I think, 14 years ago. There's been a couple of years where we took a break. Very heavy North America, Europe, and Asia. So we'll go over some of that information. Then we'll look at safety, liquidity, yield. These are the core priorities that people have. How do they differ from the size of the organization? Has this changed? Does this change when interest rates are higher, interest rates are lower, and is there shifting? So we'll cover some of that. What are your peers doing in terms of prioritizing these three factors that everyone pays attention? Hopefully everyone can see things on the screen. I see some notes in the chat box. Hopefully that's working. Brian, if you can send a note in there if that's not the case. On the investment side, we'll look at what short-term investments are being provided for in different portfolios. What are people doing? How there might be placing limits on these items, what's occurring there. And then associated with that as well, we'll look at counterparty risk. How are your peers evaluating and monitoring counterparty risk? Is this formal or informal? And I will give you a little heads up. The actions are far more informal than I think are necessary. So we'll shift from that to ESG, loans and bank relationships. One key highlight from ESG is that 49% of your peers, just under half, said ESG has become more important in the past year. And I know there's certain trends where ESG, certain elements of that have become, there's been, let's say, more resistance to that in some fronts, but 49% saw it as more important to their organization. And since this is a topic on liquidity risk, it also covers loans and bank relationships. So not just the investment side, but the borrowing and debt side. We'll look at how those positions have changed over time. And then the key takeaway side, Jeff and I will cover a few topics. One on the investment side, especially on the short-term side, what's the cash environment look like as rates have seemingly peaked, and the Fed is giving indication, as well as other central banks, that they'll continue to adjust interest rates as inflation hopefully continues to keep coming down. So we shift from a rising rate environment to a declining rate environment. I'm going to go ahead and reshare my screen just because it seems like there's more people having a problem. I'm going to just do that 1 second. Sorry for the inconvenience. I don't want. Maybe that will help. If it pushes it out again, it might fix the audience activity. Let me know if that's cleared it up. If not, maybe you could try logging in again. But after the takeaways on the investment side, we'll look on what are some of the recommendations or takeaways on the counterparty risk management side. So with that, I'll cover a couple of the survey stats. I mentioned a few of them, over 160 respondents. Heavy participation, Europe, Asia Pac, and North America. 90% have operations in North America. If you let your eyes glance over to the right, it's a lighter survey. We have about 50, a little over 50 questions. Most people don't answer that many. All of those of you who took this survey, thank you. We really appreciate it. You get more details. We thank you. And I think there's a definite learning process for those who take surveys. So that's encouragement to take the surveys, invest the few minutes or the several tens of minutes on our different surveys. You can see the size and revenue from a revenue perspective on the bottom right-hand side of the screen. But that completes the overview of the survey. Let's get into some of the results. And so maybe we can begin. Well, let's begin with the safety as a top priority, Jeff. I mentioned safety, liquidity, yield. Maybe you can take us through this.
Yeah, thank you. And thanks again, Craig, for having us on today. And thank you all for attending. Yeah, I mean, I think when we look at this slide, there's not much of a surprise here. I mean, the top priorities for corporate treasurers is to keep their cash safe. Preservation of principal is always paramount. But then there's always these, the follow-up objectives of liquidity and yield. In reality, achieving all of these objectives is the priority of the corporate treasurer. Virtually every corporate investment policy that we see starts with these three objectives, really in descending order of importance: safety of principal, meeting liquidity needs, and achieving a competitive yield or a competitive return. So I think what's cool about today's environment is that yield and return is quite attractive, that Craig already mentioned that we're at 5% or greater. The Fed has raised the Fed funds rate by 525 basis points over the past 2 years. And, really, cash is attractive. Of course, they raised those rates because inflation, got out of control post-COVID, but now we're seeing it come down. The last rate hike by the Fed was in July, and they've been on pause since as inflation has cooled. Headline CPI is now down to 3.4% after hitting 9.1% in June. And really one of the Fed's favorite measures of inflation, core PCE, now stands at 3.2% year over year. I think what's unique about that is over the past 6 months, core PCE has risen by just 1.9% annual at an analyzed rate over the past 6 months, which is really, consistent with their 2% target rate. So now the Fed and the market is contemplating when it's the right time to cut rates, and they'll still want to be vigilant against inflation by keeping rates higher for longer, but monetary policy may now be too restrictive if the Fed does want to engineer a soft landing, and particularly if inflation continues to decline. And recently the market has priced in as many as 7 rate cuts over the next year, with the first one being in March. We do think, we at Allspring do believe that it's too aggressive, but do believe rate cuts will begin mid-year and probably get a total of 3 or 4 cuts over the next 12 months. So that certainly has ramifications for where corporate treasurers put their money.
Yeah, excellent. Just the one thing that stood out to me on this, besides safety being essentially number one for almost everybody, was liquidity on the small organizations at 50%. That was the number one priority, fairly different from the other organizations. Yeah, so where's everybody putting their cash, Jeff?
Yeah, so when we look at this, probably not surprising results. Deposits are still such an important allocation, particularly from a banking relationship. There's earnings credit rates, et cetera. But interestingly enough, this year we did see 700 to 800 billion come out of deposits, and perhaps that's because of a couple things. Banks aren't always quick to increase their deposit rates to keep pace with Fed funds. They're always quick. They're kind of slow to increase rates, often quick to lower them. And then we had the regional banking crisis in March. I wonder, Craig, you mentioned just a second ago, those small banks, a lot of those those small companies with emphasis on liquidity, that's perhaps was real important to them back in March when, we saw the failures of Silicon Valley Bank and First Republic. So certainly, a trend that we saw in deposits, and that deposits generally decreased over this year. And where we saw a lot of that money go was into the second favorite here, second and third, money market funds. 1.1 trillion came into money market funds this past year, which is a 21% increase. Money fund balances are now at $66.3 trillion. We enjoyed an increase at Allspring with our money market funds. Our assets under management were up 36% in the money fund space as well. And I think, the main reason for this is that investors could really take advantage of market rates because of the short weighted average maturities of money market funds. They're highly correlated with the Fed funds rate, and investors could get, or today are getting 5.25% ish in government funds and 5.5% in prime funds. So certainly attractive rates. Most of those monies did go into government funds. We saw 865 billion go into money market funds per crane. Actually saw a decrease in demand for institutional prime funds. Those were down about 40 billion or 6%. Of course, the institutional prime fund space has become much smaller, really post-reform in 2016. That was implemented in 2016. And now we're dealing with another round. With October, we'll see mandatory liquidity fees go into effect for institutional prime funds in October of 24. So, that could actually lead to further declines in institutional prime funds. And I think what's interesting, on kind of a side note too, we saw 865 billion come into government funds, 1.1 trillion come in total into money market funds. Really, the bulk of the rest of that money was coming from retail investors, and most of those retail investors were going into retail prime funds, which were up 270 billion or 64%. So it's a pretty big growth there. Still a side note. Also on here we see CDs. Of course, CDs have become quite popular, particularly through the programs such as CDARS, where clients can take advantage of FDIC sponsorship. I do think now that we're really towards the I think that we have peaked in rates, now that we will see rate cuts going forward. Perhaps not in the near term, but certainly by mid-year. I think the purchases of direct securities, either government securities or having separately managed accounts, are ways that corporations can take advantage of locking in these existing rates with separate accounts. Of course, they allow for customization to meet liquidity needs and can be used to extend out the curve. So those are really my observations, Craig.
Great. Yeah, excellent. So you can see those numbers are just showing the percentages. So this numbers won't add up to 100% because some organizations invest in more types of securities or investments. That brings us to our first poll question. That'll show up on your screen. There's instructions about how to pull it up. If you don't see it, if it doesn't pop up there, both questions are single choice. The first is, does your organization invest in prime money market funds? There's a couple no's. There's a couple yeses. So please read those carefully and make sure you click the right one so we can see what's the perspective and the activity that those who are on this particular webinar. And then the second one is for prime money market fund investors. What do you intend to do with your prime money market funds in light of the upcoming regulations? Will they have an impact? And so there's a few options there, just trying to gauge what people might plan to do in the future. I find this really interesting. So I know this is a webinar on a survey and we have poll questions, so people love it. So we're going to say if we have 125 people type the word Allspring or the word poll in the chat box, we'll share all of the poll question responses to the audience. So type the word Allspring or poll, and we'll make Brian count those up. So while you're answering those, I'll mention a few things. So there's how many organizations participate in this survey? It was, I believe, a little over 160. And I think people are typing quite a bit in the Q&A box of poll and Allspring. There's a question maybe for you to consider, Jeff, is some banks started offering MMAs any better than MMFs, question mark. So I don't know if that's something you want to take after we go through the poll or if you want to address it right now. Money market accounts any better than money market funds? I think that's what the question is. Is that something you want to take, or maybe we'll respond later, Jeff?
Well, I think I can take it now. I mean, I think what you would want to understand, a lot of times money markets are thrown around and used in general terms. I don't, I think I would clarify with your bank what they mean by money market accounts, and just assure and just seek an answer on whether that's the same or different than a money market fund. You might find that it's just a deposit account with a money market type rate.
Perfect. Yeah, so here are the answers. Does your organization invest in prime money market funds? We have yes, 43%, no, but plan to add in 2023, another 8%, and yes, but plan to pull back or stop 2%. So that keeps us right about half are doing it, of everybody on this call. No and no plans to do so is 34%, and we're not a net investor. We don't regularly invest, so that's 13%. So a little over half of those who are investors invest or plan to invest in 2024. Jeff, I'll bring you in on the second question. It says, for prime money market fund investors, what do you intend to do with your prime money market fund investments in light of pending SEC regulations? The top one is no change. Number two, at 26%, remain invested. So there's not the action there. And then there's a couple other items that I didn't know if you wanted to comment on any of that, or it's just good information to have.
I think it's great information to have. I appreciate everyone's responses.
Awesome. Yeah, so what's going to happen in a little bit in the future? And another thing, in the chat box, you can see a link on LinkedIn for Allspring and for Strategic Treasurer. We heartily encourage you to follow both companies. Makes our marketing people delighted, makes us smile, and it's good to stay connected as well. So on the means of investing, how are companies investing in money market funds? It's kind of interesting when we ask the question, because Bank Portal comes up so heavily here, 63%. And some of the bank portals are really managed by independent portals, which only shows up at 13%. So their share is probably larger than that, but it's a little bit masked by some of the bank portal users. Brokers, a third of organizations use them, and direct from the fund, like going straight to the fund as opposed to using a portal to be able to pick from between different funds, is just over 1 out of 5 use that method. So you can see how the investment activity works there, how people are doing that. And when we shift over to investment limits, I'd love to hear your thoughts on this, Jeff.
Yeah, I think when you and I looked at this, Craig, we felt like we were a little surprised to see that there were that 40% had no policy limits. Perhaps that's really, because it's more driven by the size of the corporation's balance sheet, or the size of the positions, of their cash, the size of their actual cash positions, rather than exposure to any one bank. I think diversification is clearly important. I think, when we saw the regional banking crisis occur back in March, I think that got a lot of attention by depositors, and certainly, those that might have had monies at Silicon Valley Bank or elsewhere. I'm sure that there was some concerns around that. Fortunately, the FDIC did step in to guarantee those uninsured deposits, and the Federal Reserve was able to create the Bank Term Funding Program, which did help banks, fund any deposit withdrawals. So I think those were all positive. But I do think that what we saw post March was a big shift to increase diversification, really a move towards larger, more higher quality banks. Because really, a number of banks were affected. Even Credit Suisse, had to be taken over by UBS at that time. So there was certainly a lot of concern about deposit at that time, and certainly something that it seems that folks should pay attention to.
Yeah, the rescue of the different institutions. While there was a lot of concern, it was like, okay, nobody lost money, and so there's this whole issue of let the moral hazard continue. Maybe we don't need to monitor as much or set limits or any type of guide rails here. It is a concern that there's no policy limits whatsoever for organizations. That doesn't seem to be a defensible practice. It certainly doesn't seem commercially reasonable. So that'd be a hard one to defend. So that's going to be an area of recommendations, of course, as we move towards some of the takeaways at the end. That brings us quickly to our second poll question. Interest rates. What's your view on short-term interest rates in 2024? Increase, hold steady, or decline? You already heard the market view on that, but what's your particular view? And then the second one is a multiple choice. And this is, if your view is that short-term interest rates have peaked, what investment vehicles are more compelling to your organization? And so that one is, if you do not think they've peaked, you think they might go up or they're going to hold steady all year, you can click I do not think interest rates have peaked as the top one. Or there's also the option at the bottom of ensure. So go ahead and take those, answer those poll questions and hit submit. And again, if you type the word Allspring in the chat box and we get 125, we'll share those with everybody. And I don't know if Brian's been able to count everything up yet, but we're pretty excited about making them count. Maybe I should have said 150 or 200. But it's a lot of counting, so it's good. Interesting. We got some contrarians here. 9% think short-term rates will increase this year. So that's definitely contrarian. Holding steady, I would say that's also a little bit contrarian to what the market believes in terms of the investment market, what the Fed has communicated, and 47% fall into the majority camp of the broader market that they believe they'll decline. So yeah, Jeff, I don't know on the bottom side, what any comments on what's most compelling here? Got separate accounts, direct purchase of securities, etc.
Yeah, well, I think when I look at this and you compare it to that, one of those first slides that we're looking at where current allocations were, I think what you see is that bank deposits are lower than that poll that was taken before, and that money market funds maybe not necessarily higher, but certainly higher than bank deposits. So I think that's an interesting switch. And really, CDs and separate accounts and direct purchases securities are fairly consistent with that finding. So I do think that the best way to lock in those higher rates, if you do believe that they'll either hold steady or decline, is through direct purchases of securities or potentially through separately managed accounts. So those are going to be able to give you the duration that you want in order to lock those rates in, whereas money market funds and CDs, maybe to a lesser extent CDs, but which will be much more highly correlated with Fed funds rate.
Excellent. Well, thanks everyone for taking this poll. We've stacked two double question polls in a row because we know you can handle it. Let's move our discussion over to managing risk, measuring risk, gathering counterparties' exposures. We saw some of the responses a little bit earlier. What people were doing. 40% had no policy limits. But what are your companies doing? Do you collect and review total counterparty exposures in aggregate? 52% do it for bank deposits and CDs. So if you have deposits at banks, that's being checked, and there's probably some policy. But that number's down. If we went all the way back to 2013, that number was 60% in 2013, about 5 years on from the financial crisis. So we haven't increased that. We've decreased over this intervening decade. Credit facilities, two out of 5 are checking credit facilities, a little bit less than that for money market funds and other mutual funds. You get down to FX counterparties, down to about 1 out of 5 are doing that. And then 30%, we do not collect aggregated exposures. Now that's that I think is a good area for most organizations to look at and say, if we want to manage counterparty risk, we need to know what our exposures are, what the level is, and then there's usually some kind of calibration. What's the risk level of those exposures? And that doesn't take a tremendous amount of effort to capture that type of information. And you can certainly get a little more fancy and more nuanced in that process. But I think we probably all agree if we look at this looks a little light for what we should be doing as financial professionals and risk management professionals. And so we've seen a decline as well for large firms, moving from 76% we're monitoring to 59% in 2023, across the board. So some significant shifts there and reduction in what's occurred on counterparty exposures. That's why we have some concerns about that, or significant concerns, and the need to manage that. All right, continuing this harangue on counterparty exposure, we have this multi-year decline in monitoring. So if I act a little depressed, that's partly why. You can see the numbers from bank balances on the credit side. You still see some drops from 2015 to 2023. If you look at 2017, a little bit larger of a drop on the credit side. Investments, CDs, money market funds, those different instruments, you can see the changes. They're not going up. The level of managing counterparty risk continues to decline, even on the derivative side. And given what, if you start looking back several decades, you get the financial crisis, you get the earlier part of the year, it seems much more responsible to monitor your counterparties, track them, and certainly there can be some clarifications and considerations if you say, well, we're dealing with banks that are too big to fail, and based on the standards there, we have other the ability to move funds rapidly. All of those seem interesting, but still leave an organization exposed. So this is a picture I find a little bit sobering that it's declining when the technology is there to make it more easily monitored. Jeff, any comments before we shift to deposit balances on this?
Greg, I think your observations are spot on. There's a lot of risks out there, and I think it's important to watch them, just like we watch the exposures that are in our portfolios and monitor those closely. I think professionals should be looking at their risks around the risk to counterparties that they have in their investments as well.
So thanks everybody for letting me scold those who aren't doing that. It's a good thing to put on the list and get done. All right, now on to some more positive, happy news.
Yeah,
banks like your deposits, right?
Yeah, they do, and that's what I kind of think catches my eye is that there's a number of banks wanting to increase deposits. Perhaps that's not surprising given the decrease in deposits that we've seen over the past year. Some banks don't want deposits or need deposits. They've been able to get funding through the credit markets, been able to issue investment grade bank level bonds. But, anecdotally, we know that some banks may be looking to increase deposits. And of course, in order for them to do that, they're going to have to sweeten the deal a little bit. Deposits will have to be attractive. And perhaps that's why we saw money market funds being more attractive on one of those previous polls to deposits, just because rates are that much more attractive. So, clearly corporations can benefit from working with their banks, and can benefit from earnings credit rates or kind of enhanced rates to woo them to increase deposits. So that's something that we may see over the next year.
Yeah, your number when you said 700 to 800 billion moved out of deposits into money market funds, that helps us make a lot of sense of this number on the right. Yes, the banks wanted us to increase the levels of deposits. 0% 4 years ago, when everybody was awash in cash, to 33% say, yeah, please send it in a time of rate moves and shifts, as people are paying attention to rates now that they're not 0.001%.
Yeah, and certainly, we don't know that all those deposits went into money market funds, but certainly when you look at the numbers, 1.1 trillion into money market funds, 700 to 800 billion out of deposits. Those are big numbers.
All right. So our final poll, we have enough responses. If you want to type the word Allspring, you can, but we have enough responses. So Brian will cease counting those. This third sequence of poll questions is about bank deposit balances. Over the next year, do you anticipate increasing or decreasing bank deposit balances? So, factor that in: increase, decrease, maintain, or unsure, or undetermined. And we have enough poll questions. So, Jeff, it's a statistical dead heat on increase and decrease. Just about 20% on both sides of the maintain, and then we've got another 19% unsure, determined.
Does that mean one big unchanged? Is that what all that means? Perhaps.
Yeah, I think so. I think that means it's pretty much status quo. I wonder if the changes that have occurred over the last year or so, where there's been some realignment, if that's going to continue. Now we're going to be stable for a time period, especially if rates are on a slow decline. Any other thoughts on that?
Yeah, I do. I do think it just comes back to yield. I mean, we know that banks in general are safe. We know that money market funds are safe. They're going to meet those objectives. There's other ways to meet those objectives as well, but it is, it is a known fact that banks are kind of slow to increase their rates as rates go up, and they're quick to decrease them as rates go down. So perhaps it's not, that surprising that deposits remain unchanged here, because there are some attractive ways to earn a significant yield away from banks.
Yeah, good points. Yeah, excellent. So thanks for responding to the poll questions we've had. This is a really significant help for us. Yeah, let's move to ESG. We asked questions about environmental, social, and governance programs. Just by way of background, if you look globally, where do you see focus on different elements like environmental, social, and governance? If you look in Europe, particularly in the UK, environmental is the top item in the UK and Europe. In North America and US, for example, governance tends to be the top. And so when you look regionally, there's differences. So as you talk to other treasury people, you'll find that there's areas of different emphasis. But let's look at what we saw from this. On the left-hand side, this is a question about the ESG program status. 45% have a program in place. So we're still less than half. If you go back, we don't have to go back too many years to see that number get below 20%. So there's this long, steady climb in people that put a program together and use that. 18% are actively working on implementing a program. So if you add that 18% to the 45, that gets you to 63%. So does that mean in a year we'll be over half? I think so. Within a year and a half, I would say for sure we'll be significantly above half have an ESG program in place in the organization. Whatever those guidelines are, those will be laid out. So this is a steady movement. Organizations are, do have programs in place, are adding and considering that. May not be quite as hot as it was recently, but it's certainly moving in that direction. And 49% of organizations have indicated that it's become more important. ESG has been more important to them in the past year. So almost half of your peers say it's more important. What are the components of the program? And you can see environmental tops the chart at 85%, those that have programs. When you look at that 45%, so 85% have an environmental component. Social is 73% and governance 68%. So you can see that spread of what are the components of the program. Not every program has every single component. Some are focused on one part or the other. And so that certainly factors into how organizations are directing their investments. Jeff, any other comments on that slide before we continue to push on?
Yeah, I would just add that, we at Allspring do see interest in ESG focused mandates. A lot of that demand does come from Europe, but increasingly over the last couple of years, it has come from the US. And further out the curve, Allspring does have some established fixed income strategies focused on climate transition, on sustainability. And when it comes to meeting ESG needs for our clients, those tend to be more easily accommodated through separate accounts, given through everyone's priorities. You could see that there's, a shift in a difference in priorities on the E versus the S versus the G in the chart here. So, in separate accounts, we can really customize to that and really take advantage of our deep credit response research capabilities. A couple other things, we see a lot of DE&I initiatives in money funds. Let's see, in 2023, Wellspring did create a tribal inclusion share class for our government fund, where a portion of management fees go to NAFOA, which is the largest scholarship provider for Native Americans. So we're really excited about that. And we also started a new share classes in cooperation with Robertson Ryan, which is a veteran founded and owned broker dealer. So there's a number of ways that people approach ESG, people approach DE&I, and certainly we're able to meet those needs here at Allspring, and I know as well as many of our competitors.
Yeah, thanks for those comments and some of the background there. Yeah, you see the progress of how things are moving in that space. All right, so we're talking on liquidity risk, and now we're getting into the investment side, or the borrowing side. The first question is with regard to loan covenants, which is the most accurate about your organization. So this is that factor of what's going on with covenants. Is it easier to borrow? There's quite a bit of information about that in this research, but let's step through the numbers here. We had fewer loan covenants compared to the last time we negotiated, 20%. If you step down, you can see the blue dashed lines. It says we had more loan covenants than our last facility. So there's a net 8% fewer loan covenants. If you take the 20 that had less or fewer, and then the 12% that had more. 64% saw it pretty static, and that we do not have credit facility or debt. So we're continuing to get a little bit more simplified on loan covenants. It's a net reduction. That doesn't mean credit's more available. It just meant loan covenants might have been reduced, focused on a particular couple of areas. So a couple of things to note there. There's quite a bit more information from the survey. Now, as we continue to glide along, managing bank relationships, we talked about formality and informality with managing counterparty risk. That might be someone looks at, I look at my banks, I look at my counterparties for financial transactions, and I feel good or I don't feel good, but I'm doing that informally versus I'm tracking those. I have reports, I have certain measurements that I'm looking at and going from that point. Same thing can hold true on the relationship side. How formal am I being versus informal? So how formal is your bank relationship review? Formal, almost 60%, 58% of large firms manage their bank relationships. They have a review process. They might have a balanced scorecard. They might have, they may create their own risk-adjusted return on capital to show the relationship standpoint, from a relationship standpoint, how their banks view them. But you can see the formality of the larger firms is in the majority. So almost 60% of large firms, or firms over $1 billion in annual turnover revenue, are formal. Dropping by almost a half is the medium-sized firms. 31% have a formal way of managing bank relationships. Most of these organizations have some way of managing bank relationships, but it may be informal. So some of those factors might be: do you have a relationship management policy, relationship management framework, how you're going to do that. How do you involve the relationship at your organization with your banks? Is it just the treasurers talking to the banks, or is it multiple layers of senior management across the organization having a relationship with your key credit banks? So those can be some factors. What's written? How is this tracked? How is it institutionally managed over time? And so a couple of those factors in the bottom, we say, do you update senior management? That's just about 60%, 59%. A formal scorecard, just over half, so 56%. Do that if there's a formal way of doing it. Over half of those that are formal create a scorecard. And a share of wallet exercise. How are you dividing the revenue that you provide your banks? How are you allocating that to your different creditors? 37% do that. And then those that document all bank meetings, 26%. So just over a quarter. And maybe you're thinking, why would we document all bank meetings? Why would we record what we communicated with and decided with the banks and capture that in a way so that we can institutionally keep that organized over time? This is an area where banks are extremely formal. They have bank call reports. They meet with you. They document those meetings. They have a plan, and they work that plan, and they document it. This is a good practice. A lot of times documentation on the corporate side is people have handwritten notes, or they keep things in their own files. And then when the person leaves, that information disappears from any type of reasonable access. So this idea of at least documenting your plans and your purposes and tracking what the results are of those meetings matters significantly. Very, very few are doing that. And those are opportunities. You have a meeting. It's important enough to spend the time. You're looking for credit over a long period of time. You're looking for advice, leadership, and good services. This is another area where formality can make a big difference. Time tends to be against us, but this is an area where there's certainly room. Documenting bank meetings takes a lot less effort than creating a formal scorecard or a share wallet exercise. But all of these can be done. So maybe that's something you think about in 2024. What would we add to help increase the formality and effectiveness of how we manage our bank relationships? Then if you look at the small organizations, those that are under $500 million, only 13% manage those relationships formally. Now, they tend to have less relationships, but those are, very, very, very few of those are managing them in a formal manner. Jeff, as I talked about these things, I know this is not the investment side, but it's certainly like the other side of the coin about managing your portfolio. I didn't want to just move on without giving you an opportunity to comment if you have any.
No, Craig, I think your observations are highly appropriate. And, I think there is a good analogy between managing the credits that are in one's portfolio versus managing the counterparties that you have in your business. So good observations.
Yeah, and I think I've been a little bit of a scold in today's sessions, like be more formal. But I think there's good reason for it, and we can all understand it. So that brings us to our final thoughts, and we have a fair amount to talk about here. So we'll be camped out on this for a little while. As we look at this environment, maybe Jeff, you could start us off on the first half. I'll talk about the second half, but I do want to go back and forth on this, on these points to some extent.
Well, I think it's not up for much debate. I mean, cash is attractive. I mean, the good news is on those original objectives, we're able to actually earn an attractive yield, collect significant income on our cash, in today's current environment, which is a nice change over the last few years. At 0% rates, there was perhaps less to choose from, less motivation to consider options, et cetera. But in today's environment, 5% is, quite attractive. And I guess the big question is, how long does that stay? We believe that the Fed is done raising rates. We think that rates have likely peaked, and perhaps the market might be a little ahead of itself in pricing in rate cuts, but we do believe that rates will be lower by the end of the year. So, to the extent that you can take advantage, that corporate treasurers can take advantage of that, there are options for doing so, and we do think that this is a good time to consider locking in higher rates, because a year from now, while I think rates will still be attractive. I mean, even if we're at 4% or 4.5% in Fed funds, those are still going to be quite attractive, particularly relative to what we would believe to be a much more contained inflation number. So I think in this environment, it's a good time to consider locking in those higher rates.
Yeah, that makes a lot of sense. When rates were zero or close to zero, and cash was, the market was awash in cash. Activity, the activities that we took weren't as important, I guess, in this environment of significantly higher rates than we've seen over the recent decade and a half.
Yeah, that's right.
So there's a bold statement that the Fed is done raising rates, when I think we saw that 40% of people here think that may not be the case. But maybe you can walk us through that one too.
Well, I think what I saw is 40% said that they felt like rates could stay the same. Just a few actually thought that rates could go higher. That's a possibility.
Okay.
I mean, it's certainly a concern of the Fed. The Fed wants to ensure that they've really, put this fear of inflation, actual inflation. They want to make sure that they put that to rest. The last thing that they want to do, start cutting rates early, only to see inflation, raise its head again. So they're going to be really, judicious, very, concerned about cutting rates too early. And we'll start to see, on January 31st, we actually have a FOMC meeting. We'll see another one in March, and we'll start to see what their communique is. But I think the big shift that we saw in the market last year was that they actually did say that they kind of acknowledged or were quite pleased with what inflation was, what they were seeing with inflation, that they were happy with the disinflation trends. And then at some point, if they are going to engineer a soft landing, they might need to actually cut rates because inflation has come down. So, there is that risk of a real slowdown of a recession, on the other side. And so they want to make sure that they, appropriately navigate this environment by adjusting the Fed funds rate appropriately so as that they, make sure that inflation has stopped going up, but also they want to ensure that they're not too restrictive on the economy and throw it into recession. So it's a tightrope for sure, and we're going to see some, we're going to be able to see some, a number of economic numbers before they meet again in March. I think it's a foregone conclusion in January here. At the end of January, they will not be changing rates, but the communique that we see out of the Fed will continue to be interesting.
Jeff, I don't know if during election years, has the Fed ever raised rates, or do they almost always lower rates during an election year? I know there's not supposed to be the influence of that, but
yeah, well, I think the Fed really what they want to display is that they're independent, right? That they are not political. And, many could argue one way or the other, but they do want to establish their independence. And I do think that they, I think they'll likely take the November 7th meeting off, just given the fact that, that is around election time. So, but I do think that, the main key for them is they want to maintain their independence. And we know that, many politicians will state otherwise, but, I think that their job is to keep inflation low, keep price stability, and keep a full employment. And quite frankly, they've done a really good job on the employment side. I think they have to be really pleased with the fact that we're still continue to have very low employment, continue to see very strong job numbers.
Yeah. Now the third pillar, I was slated to talk about it, but I don't know if we can just call an audible and have you talk about it. I think this is really an interesting one about the mandatory liquidity fees. That starts, at the very beginning of the fourth quarter. That's a change. Are you good with talking about that, or you want me to
Sure,
keep
happy
with it?
to.
Sure. Okay.
Certainly, and we took a poll about that. It seemed like what I took away was that not a lot of the respondents were too concerned with mandatory liquidity fees. And of course, those are fees that will be implemented to those that withdraw funds on days where net redemptions are greater than 5%. And so, I think that I do think that we'll probably see some consolidation in the prime fund space. I do think that we'll see some flow to some larger funds. I think that was indicated in our polling questions. But this is a real change. Post 2016, everyone got very accustomed to a floating NAV and fees and gates. Of course, those fees and gates, as we know them, as they were attached to the 30% liquidity requirement, those have been removed, which I think that was a good thing. I think that certainly caused some concern in and around the COVID. When COVID first started, there was some flight to quality, and there was some concerns about those fees and gates. I think it was smart that the SEC took those out. But they did come back with, in kind of another way. And there is, with the new mandatory liquidity fees that will go into effect in October, I think there's some question marks exactly on how those will be implemented, and what's the transparency one will have for that, and also the magnitude, how big will they be? So I think there's some question marks about that. Prime funds will continue to offer additional yield versus a government fund, and that's what's always compelling. And those are perhaps, I think, one of the trends that we've seen by our clients over the past couple of years is perhaps their initial layers of liquidity are in those bigger buckets that we saw, deposits and government funds, but that there's still a place for prime money market funds and to get that additional yield. But it is important for those that are in this space to understand what those mandatory liquidity fees mean, how they're implemented, and it'll be interesting to watch as we get closer to that October 2nd implementation date.
Do you think there's and I don't know if Allspring takes a position or if it's just something that we talk about as individuals, but the law of unintended consequences, or the principle of unintended consequences. We've seen some of that with some of the money market reform that's occurred over the last 15 years, where you get concerned that a fund can freeze or halt distributions, and that creates a more rapid movement out of the fund. If you think that it might close, it might trigger a stop. What do you think the potential is for mandatory liquidity fees, creating if there's a concern that people will move to try to get ahead of the fees, in, let's say, institutional prime funds?
Yeah, I do think that that's possible. I think your comment about unintentional consequences is legitimate. We certainly saw it with the last round. In 2016, the rules were implemented in 2016. We saw that come forth during COVID, and so they tried to fix that, call it unintentional consequence. But now perhaps we have a new one. So I think the SEC is certainly intent on maintaining a stable and financial environment, particularly as it relates to money market funds. So perhaps that they can solve for it at this point. But it's a difficult challenge. It's a difficult goal.
Try to avoid the ditches on both sides of the road, right? Make things more stable without creating other unintended consequences. So on the last pillar here, or final thoughts, managing and monitoring counterparty risk. You've heard me mention that I believe it's risky to not monitor exposures. I don't think it's a a standard of good corporate conduct. I don't think it's commercially reasonable not to do some monitoring. So the question really is, without saying you have to do everything at a really heavy level involving a ton of staff and a ton of systems, I'd say the first thing to do is determine what level of formality you need and you should have to manage and monitor your counterparty risk. Is it simple to say, identify the major areas, levels, and put some limits in place? Is it something that's going to be more automated? There's a whole range or continuum. Not doing anything usually is not a great answer. Doing everything is probably not viable for most of your organizations. You don't have the staff to do that, or necessarily the systems in place to do everything that possibly could be done. But what's a reasonable level of formality for managing counterparty risk and managing relationships? Putting a couple things in place in 2024 will be a great thing for your organization. So the last point is do it now. Write some things down, talk with your group about what you can do in 2024, and do something. Whether it's capturing all of your notes from your bank relationship calls, whether it's saying here's our list of our core counterparties exposures and what levels we want to manage to. Do something and do something now to become a little more formal if you're on the very informal side of things. If you're already doing it, congratulations, you can see what a small percentage of your peers are doing that. So definitely some opportunities. Jeff and I, Allspring and Strategic Treasurer, want to thank you for spending some of your afternoon or late morning with us, or even evening. Looks like we've got people from all over to talk about this. For those that took the survey, completed it, thank you so much. Thanks for your time. We'll turn it back over to Brian Beeks. Again, Jeff, thanks so much for your time and your insight on the liquidity risk survey.
Yeah, thank you, Craig. My pleasure.
Thank you, Jeff. Thank you, Craig. And thank you, everyone, for joining us today. The CTP and FP&A credits, today's webinar slides, and the recording of today's webinar will be sent to you within 5 business days. And be sure to download the Liquidity Risk Survey report by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.